Hello, welcome back. In this video, I'm going to prove a point. I'm gonna show you how insensible, how weird the stock market can be. And so in this one, we are going to compare two companies of different industries for which you would expect completely different financials. And we're gonna chat about why this is extremely absurd right now. These companies are Coca-Cola and Meta. And so we're going to, first of all, this is going to be a relatively short video because I'm going to be looking at what I typically do here, the stock analysis chart and the view, this kind of view where we have the foundational metrics. And in this one, we're kind of seeing Coca-Cola and how it has been growing throughout the years. But as you'll see right now, Coca-Cola is down almost nothing from its recent highs, 2.5%, 2.6, that's almost nothing. And it is a company that is generally speaking a good hedge against inflation. But regardless of that, I wanted to kind of show you what's going on with its financials right now. So let's take a little bit of a look. The P ratio of the company is 29, as you'll see here, and it has been sitting at around these levels. Now remember, this company is not a tech company. It's a, as you see here, consumer defensive sort of a beverages company. It's a company that generally speaking will be growing at a very steady low pace and will for the most part be getting a better balance sheet over the years. That's the whole point. It's a steady company that's basically a dividend company, an income company that is going to be paying back shareholders in the form of a dividend. As you'll see here, the company already pays 2.6 in terms of a dividend, which is also relatively expensive based on what their payout ratios are. But the point here is that we're looking at a 29 P ratio company, which should ideally have almost half that. Because again, this is not a company that is growing, and so if we're paying 29 of a earnings multiple, we should generally be expecting a company that is growing more than a company like Coca-Cola. Because Coca-Cola is growing at a 5% revenue, at a 9.2% revenue growth in the last 5 years. So basically, practically speaking, they are at the same level. It is at the same level and slowly creeping upwards in terms of revenue. Now, while we're at it, I'm gonna be comparing this directly to a company like Meta. And so here I have Meta Platforms, and we're gonna do the same thing. Now, Meta is a completely different story. It is a company that is not paying any dividends, as you'll see here, and it's a company that's growing its revenues massively, as you'll see here, from 40 billion to 120, almost 120 billion over here. So compare this kind of revenue growth here, Coca-Cola's and Meta, and tell me which one you would pay a higher multiple, a higher earnings multiple for. Because for me, that would definitely be Meta. It's growing much faster, so I would be willing to pay more for it. But what is Meta's current PE ratio? It is 15.3, is half that of Coca-Cola. Now let's go back. Coca-Cola's price to free cash flow ratio this time is 25. Surely that can't be more than Facebook, right? I mean, again, this is a company that's growing much less than Facebook. Its 5-year free cash flow growth has been 107%. And Meta's 5-year free cash flow growth has been 123%. Now this is still surprising growth for Coca-Cola, but take a look at the absolute numbers also. This is 5 billion here, and it has grown to 11 billion, and Meta is actually 20 billion over here, 17, and it has grown to 39. And as you can understand, it's much more difficult to grow when numbers are getting higher. And yet Meta is actually growing more than Coca-Cola in terms of its free cash flow, as you would kind of expect from a company of this sort. Now, what else? Surely the company must be more solvent, Coca-Cola, right? Must be having better cash flow when you compare it to its total liabilities. Must be sort of like in a better position to handle any debt, right? We're having a 6.17 here in terms of its free cash flow to total liabilities ratio. And if we take a look at Meta, we're having a 1.05. This means that it would take Meta 1 year of its last year's free cash flow to actually pay all their total liabilities back, while the same thing for Coca-Cola would take 6.17 years. So almost 6.2 years. So then, what is going on? Maybe Coca-Cola has better margins? Well, Coca-Cola's net income margin is 25%. It's a beverages company. And Facebook is a tech company, so it's bound to have better margins, and it does. It has the 33.38 in terms of its margins. So the return on equity is 30% for Meta here, and it's probably the only thing that's actually better for Coca-Cola, as you'll see, which is 44.5%. I'm actually surprised at this number. Return on invested capital 13.9%, and Meta over here 32.3%. Massive difference here. So as you can see, and the point of this little exercise here, this little video, is to notice that we are talking about a company right now that is having much better growth than the other company, than Coca-Cola here. So much better growth in pretty much everything that's important here, and also much bigger absolute numbers as well. And it's selling at a much lower valuation here. And so now we're having a company that is also actually paying a dividend to investors. And again, these kinds of companies, they typically have much less multiples, much lower multiples, because again, they're distributing income to shareholders. Distributing income is less tax efficient as well. And also these kinds of companies, they don't grow that much because they don't utilize their income for operations. They mostly give it back to investors. And over here we're having a company which is trying to grow, and it is growing pretty nicely. And so you can understand how absurd the stock market can be. We are looking at two companies here for which obviously Coca-Cola is much more overvalued and than Meta. And Meta is actually growing much faster than Coca-Cola, and it's doing better financially speaking, significantly better. And so which one would you buy if you think about it objectively? Does it make more sense to buy Coca-Cola or Meta? And you may say Coca-Cola in some situations where there is high inflation, of course, and that does make a lot of sense. Yet the thing is, you are always and should always be trying to buy something that has lower value and keep it for the long run. And if we're talking about Coca-Cola right now, is a fair company that is still a little bit expensive though. But Meta, on the other hand, because of the current situation, because of the current market, because of the current inflation, and mainly because of the current sentiment, is actually down to levels that have long been not seen before. And frankly, they're kind of ridiculous. The company is trading, think about it for a minute, the company is trading at a lower multiple than Coca-Cola. So Facebook is trading at a lower multiple than Coca-Cola, both in its PE and its free cash flow ratio. That's insane. And obviously, again, this is a highly growing company, Facebook. And I thought I had to make this video just because it can prove a point. Of course, it doesn't mean that you should necessarily buy Facebook or anything or Coca-Cola, but it's really important to understand that we are not talking actual numbers here and actual values in terms of these two companies. We're talking about sentiment and market values, and these things can change from one week to the other. And the good thing about it is that while the market remains insensible in terms of how it's pricing these kinds of companies, this is when I personally like to accumulate. And this is why I got a lot of Facebook, and actually Facebook is my top holding. Now, I was lucky because I actually bought Facebook in the previous sort of like crash when it went down to about $150 or so. And I bought it back then when it was the Cambridge Analytica scandal. And then it skyrocketed after that, as expected, as I would expect. I think something similar is bound to happen sooner or later because the company's financials are just so stellar that it just doesn't make sense. You can't be leaving money on the table for too long in this company. And even if they have a bad quarter, it doesn't mean much. I mean, let's just say that they miss on guidance, actually they miss on earnings, and they potentially give a lower guidance than expected. So what's the problem with that? Yeah, the current sentiment could bring the stock down even more, but practically speaking, the business is so good that I would really think about buying more here, just because this valuation is so ridiculous that it's frankly a little bit insane right now. So hopefully you enjoyed the video. Tell me if you liked it. Tell me what do you think about Facebook, and yeah, just leave a like and a comment below. And please remember to subscribe. It's minutes, sort of like almost, it's actually a few hours before I will let you know how to get access to the tool, this tool. And yeah, you may want to stick around for when that happens. And thank you for watching this video. I hope you enjoyed it. I'll see you soon. Bye bye.